This video will be broken down into 3 levels, with the more straightforward strategies at level 1, and then we go more complex from there. If you live in a higher income tax state, it's actually not that hard to get into the 30% plus range for your tax bracket between federal, state, and Social Security and Medicare taxes. If you're new here, hi, my name is Lydia, and I work as a pharmacist in the hospital. I think there was this assumption that once I graduated and got a solid paying job, then we should be pretty set, right? It sounded like a lot of money, but in reality, sometimes it doesn't feel that way. And when we look closer at some of our expenses, our highest ticket item is actually taxes, like beyond the mortgage and beyond childcare and all the other things. Let's get into the strategies, but first, 2 important disclaimers. 1, I am not a financial advisor, I'm not a CPA, I'm not a tax attorney. I don't really know your circumstances, so treat this as a starting point and do further research. And then number 2, just because something is tax advantageous doesn't make it a good investment. I like to always zoom out and just look at the big picture. Level 1, let's start with the basic options that are the low-hanging fruits. The first one is a 403b or 401k, which is your pre-tax account that's available through your employer. A lot of these programs also have an employer match, which means if you're putting in $1,000, then your employer is also matching that $1,000, which basically is free money. The contribution limit for 2023 is $22,500. Initially, I thought, well, let's just max it out every year anyway. Why wouldn't I want to shave off as much taxable income as possible, right? And you can do that, but there are some downsides I want you to consider. The first thing is that there are minimum distributions when you turn 72. So even if you don't need that money, you will need to start taking it out and there will be income taxes on that money. And then the second thing is that the investment options within this account can be rather limited. And then the third point is that this money is quite illiquid because there aren't many ways you can take it out without penalty. Could this chunk of cash be better invested elsewhere, like buy real estate, buy business, whatever else? And how much do I want to allocate to these 401k funding options? So personally, I just go slightly beyond the match amount and that's it, but everyone's strategy is a little different. Next is the 457. This may be available to you if you work in government or in a nonprofit. And I think of it basically as like an extra 403b or 401k. It's also pre-tax and then you taxed at the end when you pull it out as income later. But the 457 has its own $22,500 limit separate from the other 403b, 401k limit. So yeah, if you wanted to max out your pre-tax contributions to whatever account is available, you could max out both and take out like 45k from your income. I personally don't do that because I want to maintain a certain amount of liquidity as I mentioned. The third thing is a backdoor Roth. So the Roth IRA is a post-tax account. You put money into it after taxes, but then once it's in the account, it grows tax-free, and then when that withdrawal is also tax-free. You can start withdrawing as early as 59 and a half years old, and a few nice things I like about this is that, for one, there's no minimum distributions. If you don't need it, you could keep the money in the Roth forever and ever and pass it down to your kids. And if you do need it, the contributions, like the original money you put in, is not taxable after 5 years. So if you put in like $5,000 today and 7 years later it grows to $7,000, that $5,000 you can take out if for some emergency reason you need to use it. Ideally, I don't want to do that because I want the money to keep growing tax-free, but it's comforting knowing that that's an option. Now, because of your income, you are probably not eligible to directly put money into a Roth IRA, but you can still take advantage of this account by using the backdoor Roth method, where you put post-tax money into a traditional IRA. You're not claiming a tax deduction for doing that. You are basically just taking the traditional IRA and converting that into a Roth almost immediately so that you avoid any earnings during that time it was in the traditional IRA. The main annoying part of the Roth is that there is a $6,500 limit as of 2023 unless you use the mega backdoor Roth method, which we will cover in level 2. Next is the 529 college savings account. It's similar to Roth in that it's post-tax money and it grows tax-free. You withdraw tax-free for college expenses, and there's a whole list of what counts and doesn't count for college-related expenses, so make sure you know what you're signing up for. The downside of this account is obviously the beneficiary needs to go to college, or their sibling or someone in the family needs to go to college to use that money. And also, the investment fund options within these accounts are actually pretty limited as well. I think actually more limited than like your typical 401k or 403b. The main draws, personally, I think are, one, if the grandparent is the one owning the account, it's really useful for for gifting if they are in the stage where they're kind of estate planning and figuring out how to gift away their assets to their grandkids. And also, grandparent assets are not considered in the financial aid application process. And the second thing is that some states offer a tax deduction, at least at the state level, for contributions to 529 plans. So for example, in Minnesota, you get to deduct $3,000 per year for the household if you contribute to one of these plans. If you live in a high tax state, it might be worthwhile to consider. Next, we have the Health Savings Account, or HSA. It's only available to you if you have a high deductible health plan, and I personally love this account. The money you put in is pre-tax, and once in the account, it grows tax-free whichever investment vehicle you're choosing, and if you withdraw the money for healthcare reasons, it is also tax-free. And unlike a flex spending account that you might have with a higher premium health plan, the money doesn't expire in a health savings account, so it could keep snowballing and becoming a bigger and bigger pot of money. Now, you may be thinking, wait a minute, I have a family. Can I really go on a high deductible healthcare plan? Personally speaking, all of our employer-based options have an out-of-pocket maximum. And when you compare between the plans, highest deductible versus our lowest deductible plan only has a $2,000 difference. That seems like a reasonably small risk compared to the upside of guaranteed low monthly payments and having access to an HSA. Oh, and if you want to further strategize with your HSA, there's no time limit on when you have to take those reimbursements. You can do it right away, in a month, in 10 years. Really, it's whenever. Could you possibly stack up all of your receipts for like 30 years and then take a giant lump sum when you retire? Probably. Or you could have a stack of reimbursements waiting to be cashed out when the value of your HSA portfolio is up. I'm not personally organized enough to do that, but something fun to think about. The last thing I want to share in level 1 is the Dependent Care Flex Spending Account. This is available to you if your employer offers that, and you basically get to put pre-tax money into this account to help pay for childcare expenses. There's unfortunately a cap of $5,000 per household, which is hilarious because that's like half a kid. But hey, I'll take it. Moving on to level 2, let's do something slightly more fun. We'll start with the Mega Backdoor Roth. To understand this, you'll have to think of your retirement money in several buckets with different capacities or limits. The employee chunk of the retirement money is limited to $22,500, and that's your 401k or 403b. And then maybe separately you have the 457 and the IRA buckets. Those are not included in this. Now, your employee retirement contributions is only a small part of your total retirement cap. Within this bucket, there is the employer match money, and then whatever space remains in this $66,000 bucket, you can potentially put post-tax money. Now, it's important to note that not all 401k plans allow this. Mine doesn't. But if it is allowable, you can contribute additional post-tax money into this post-tax 401k chunk, and then you swap that into a Roth 401k. There's a little bit of work with this, so make sure you're consulting with a professional. You also don't want to contribute too much into post-tax 401ks because if it cuts into your employer match, your employer just won't match. And then you're just missing out on free money. I've personally not used this method because of the limitations on my plan rules, but there is yet another method which I will talk about in level 3. The second thing I want to talk about in level 2 is harvesting losses. So you want to get into the habit of tax planning before the calendar year ends and not just think about taxes in April, like 2 days before it's due. This will give you a chance to look at all of your investment positions and sell whatever losses make sense if you can use that to offset some gains. Obviously, don't just sell stuff if it doesn't make sense in an investment. And I think similarly, if you do your planning early enough, like late summer, fall, and you have some idea of how much your tax bill is going to be at the end of the year, including withholdings, you could explore buying a business or some real estate, because if you factor in some of the tax savings, you're kind of purchasing this asset at a discount. All right, next we have municipal bonds. These are basically loans to like the government to pay for all sorts of like local projects. And the interest you earn from these are often tax-free. The last thing on level 2 is kind of a weird one, credit card points. Because the rewards you earn on those are not taxable, you can almost treat this as like extra untaxable income. And between you and your significant other, or player 2, as they like to call in the credit card space, you can very realistically earn like 10K to 20K per year in value, especially if you have travel spending and depending on how aggressively you're getting new credit cards. Caveat, of course, is you need to have good credit and you need to be responsible, but there's very little downside if you're doing this correctly. Level 3 is more advanced, and they are business-related tax strategies. If you're thinking, no man, I don't want a side hustle, I already make good money, if I wanted more money, why don't I just pick up another shift? I was actually stuck in this mindset for way too long because I thought of side hustles as an hourly thing. And yeah, of course I can't make doctorate level money on a thing that I'm starting completely new. But here's the thing, there's an upside that is not immediately realized. You're putting in time now for a future reward, and that reward is potentially uncapped, unlike the linear nature of hours versus pay in your job. And then as it relates to this discussion, there are obviously some tax benefits. To start a business, it's important to point out that you don't need an LLC or any formal business structure. By default, you're a sole proprietor, and you can feel free to go ahead with the LLC for legal reasons, but the IRS, for tax purposes, doesn't really care about that. As for what you could make a business in, the IRS guidance mentions it just needs to be done regularly with an intent to profit from it, and it could totally be part-time as they explicitly state. A few examples could be a rental property, or you can be a part owner to someone else's business if you're looking for something more passive, or if you have a hobby that can be monetized like legitimately, because you don't want the IRS to argue that that's a hobby, not a business. Like if you like crafting, you could sell bespoke cards to people. You could even have a business where you dress up as Santa once a year to take pictures with kids, and then like be Easter Bunny once a year to take pictures with kids. Like that would be a legitimately, regularly occurring business with an intent to profit. I also have a friend that has a bunch of goats, and she could totally set up this goat yoga situation with some glamping in her farm. It would be an amazing business. The ideas are endless and I can totally keep going. And once you think of having a business, that gives you access to a bunch of tax incentives. Whatever costs you accrue in starting this business, it could be buying a course to learn a new skill, you could be needing initial supplies, marketing, or you could be buying lunch to someone who you're seeking out as a mentor, just so you can get their ideas and feedback and advice. That would be a startup cost. And then once you have this business up and running, there are additional deductions, whether it's office supplies, camera equipment, travel expenses, basically anything that's ordinary and necessary for performing this business. So if I have an Airbnb, which I do, and I need to travel there to make some repairs, take new pictures, or do whatever work I need to do with this Airbnb, that travel expense is deductible. If I have that goat farm glamping experience, then all the care of the goats, like the vet stuff, what they eat, the actual glamping materials, all of those are for a business purpose. In the crafting example, my cost of purchasing crafting supplies and any courses I want to take to improve my crafting become business expenses. All of these deductions, some of which are things you enjoy anyway, can very much tip you into a tax loss, which can help offset some of your W-2 income and reduce your tax bill. The other kind of deduction, if you have like a larger asset like a home for real estate or for Airbnb, you get to use depreciation against any earnings. The idea is that a house has a lifespan, a commercial building has a lifespan, it doesn't last forever, and every year it depreciates by a certain amount. It doesn't matter if the market value of this real estate property is actually appreciating, that doesn't matter. A residential property in IRS's eyes depreciates over 27 and a half years, and a commercial property depreciates over 39 years. And so every year you get to take between 2.5% to 3.5% of that building's value as a deduction. It doesn't sound like a lot, but if the cost of the building, not the land, the building is like $500K, then divided by 27 and a half, every year you get over $12,000 in depreciation, which can very likely offset a lot of your gains. And so yeah, if your business of choice is real estate, you're almost always going to be either at a loss or pretty close to it, at least on paper. If you want to kick that depreciation up a notch, there are ways to accelerate that depreciation. There's this thing called a cost segregation study, which basically splits up the house into the windows, the carpet, the doors, into separate components. And of course, a kitchen appliance doesn't last 27 and a half years. Each component depreciates on a faster schedule, thereby accelerating your depreciation amount that you can take every year. You can further accelerate this using bonus depreciation, which I believe for 2023 is 80% of the total value. Obviously, 80% of all the appliances, fixtures, carpet is going to be a lot more than just taking the straight line depreciation. A cost segregation study does cost money, so make sure you talk to a professional and see if this is the right move for you. Now, besides specific expenses within the business and depreciation, there's also usage of your home. Like if there is a room that you specifically use to film YouTube videos, or you have just a space that you use as your home office for doing real estate stuff, then yeah, you have a home office. You can then take a portion of your home insurance, your interest payment in your mortgage, property taxes, any HOA fees, utilities, all of your whole house kind of expenses, and take a portion of that to be deducted for your home office. Now, this one can't take you into a loss, but whatever deductions you can't use for this year just rolls over to the next year for when you do eventually have a profit, and you can use that to offset. Additionally, if you hire your kids for your business, then that is also a business expense. What your kids can do probably depends on their age and their skills and interest, but some examples, they can feed the goats. Sorry, I love this goat yoga example. I'm still trying to convince this friend. They can maybe move the laundry from the washer to the dryer if you're flipping the room in Airbnb. They can refill the water and the coffee for the guests. They can model in your social media content. If, say, you have a beach house Airbnb that is very geared towards family and you wanted to create an Instagram reel that showcases how you load all the beach gear, the baby gear, into the cute little kid wagon and you walk to the beach and have a great day with the kids. That Instagram reel will need models to produce, and it is a pretty ordinary marketing related expense. If your kids are older, they can even do more substantial jobs. Like they can manage your social media account if you have one. They can do some data entry. They can help you with the crafting if you have this crafting business. And the main things to remember is you got to pay them reasonable amount of money. Like I can't pay my kids $1,000 for showing up in an Instagram reel. And you got to keep track of what work they did, when they did it, and how much you paid them. You could also do the same thing with elderly parents who are retired and if they want to help with your business. Essentially, you're shifting your income from someone who has a 30+% income bracket to someone who has a 0%. As long as they make less than $12,000 a year, which most kids do, then they don't have to pay taxes. Additionally, taking it one step further, business education is an expense, right? And so if your kid is a very regular employee of yours, they're old enough to take over your social media account, for example, and they're supposed to post one Instagram reel every week. You could potentially pay them to take photography lessons or marketing courses to help improve their work for your business. I think obviously you still need to be reasonable. Would you pay another employee to do this if it wasn't your kid? But yeah, that's something fun to think about. Continuing down the path of hiring your own kids. Once they have earned income, then they're eligible to open their own Roth IRA. A Roth is especially ideal when they are so young because they have zero tax in and the stuff grows tax-free. And obviously they also have tax-free withdrawals in the future. So potentially they can use their own Roth monies to fund their own college, and Roth money is not considered in a financial aid application. The next strategy is the solo 401k. So in addition to your retirement accounts at work, as a sole proprietor or a solo LLC owner, you can set up an account called the solo 401k. Remember that previous bucket of the $66,000 of retirement money? You can add to that remaining space here using this solo 401k account, essentially giving you access to that higher limit if you want. Compared to the employer-based option I mentioned in level 2, this one has so much more flexibility. First, you don't have to worry about if it is allowed by your employer plan. And secondly, there are just so many more options for what kinds of assets you can buy within a solo 401k account. If you're interested in buying real estate, some crypto, NFTs, whatever, you can do that within a solo 401k. And so when you couple this solo 401k thing with the mega backdoor Roth, where you're putting post-tax money into your solo 401k, converting that to Roth. And now you may be able to have this one whole Bitcoin that sits in a Roth 401k that grows tax-free and eventually you can take it out tax-free. It gets very interesting. Make sure you look at the rules. It's definitely a little more complex. Like if you buy real estate, then you and like a whole number of other relatives can't live in it, can't benefit from it directly. So make sure you talk to an advisor before you try something crazy. Oh, and one more thing about this solo 401k. As a solo entrepreneur, you are now both the employer and the employee. employee. You, the employer, can provide an employee match to yourself, the employee. And that amount can only be up to 25% of whatever the net profits are. So you have to have net profits, which may not be a whole ton when you're starting out or if you're just maxing out deductions and buying new real estate every year. But hey, if you got that goat yoga camping business started, and it's bringing in a giant amount of cash, that employer match can be a really powerful write-off. Lastly, depending on the kind of business, your business may be able to rent out your house from you, the person, for 14 days or less for like an event, a retreat, something that's business related. I actually learned this tip recently in a workshop through Ocho, and I was kind of mad at myself for not thinking of this because I know the 14-day rule for Airbnbs, where if you rent out a house or part of the house for less than 14 days of the year, you won't be taxed on it. Your business can write off this expense, but you taking in the income doesn't have to pay tax on that. It's crazy I never thought to use the opposite way. Now, I want to end with two important caveats for business-related tax strategies. Firstly, passive activity rules. If it is a long-term rental real estate, or if you're a passive owner in like someone else's business kind of as a partner, any income or loss from that activity is deemed passive. And passive losses cannot be used to offset W-2 income, which is non-passive. You can still utilize the other strategies like home office, hiring your kids, all the other stuff. It's just that even if you get into a paper loss, that loss doesn't help you with your W-2 income. It's just suspended to future years to offset future gains. Now, you could turn your passive losses through rental activities into non-passive if you can qualify for a real estate professional, and that is through meeting requirement on a number of hours. You probably can't do that if you're full-time. If you have a spouse that can do it, it would still work for you guys as a team, but make sure that spouse is actually actively participating in the business. The second way to get around it is more the Airbnb route, as long as your average rental period is 7 days or less. I'll link to a channel that has some real estate CPAs talk about this because they can probably explain it better than I can. The second important caveat or caution is self-employment taxes. If your business makes a net profit, that income is subject to both Social Security and Medicare taxes. And now since you're both the employer and employee, you're paying both sides, which comes out to around 15%. I think you can always find ways to deduct that and minimize that. And the nice thing is, for anyone who already has high W-2 income, the Social Security tax is capped at $160K. And so if you're already above that, this may not really matter to you. I feel like that was a lot of dense information. Let me know and let others know in the comments below whether I missed something or if there are other tax strategies that you find really useful. And also, if there's anyone who you think can benefit from this video, feel free to share it with them. I totally wish someone made this video and sent it to me 10 years ago. One final reminder to treat this as a starting point, as my best attempt to summarize what I've learned, but I fully expect that you will do more learning on your own and figure out whether these tax strategies can work for you. Anyway, thanks for watching. Please subscribe and I will see you next time. Bye.